Hello, everybody, and welcome to this week's bi-weekly community call. We hold these calls every other Tuesday at 9 a.m. Eastern and 1 p.m. UTC, and look forward to seeing our members at our next call, which will happen on September 12th. Today, we have one of those days where we have a really packed agenda with a lot of reviews and highlights. First, Brave will walk us through the new phase in the tokenomics project, where members are continuing to discuss liquidity parameters, signaling their preferences about the time frame, about the redeem mechanics, and finer tune the details. Then Brave again will walk us through our partnership with Chaos Labs, which I find quite interesting and look forward to reviewing their work. They will audit the ratcheting AMM design that the Foundation and DAO R&D teams are working on. Then he will briefly review the staking dashboard, which is now live. It's a really helpful dashboard to review all the different staking pools, which basically open up capacity for members to buy cover. It's a very vital part of the Nexus Mutual ecosystem, and we now have a very helpful tool, so looking forward to that in detail. And then Brave will highlight the latest capital pool investments and showcase how Nexus Mutual made it to headlines both in traditional finance and decentralized finance outlets. Then we'll hear from Hugh with his weekly update from the Foundation, and then analyze our last week and have some time for an open forum. Let's get things started with Brave. Would you like to take it away, Brave?
Yes, thanks, Sam. Yeah, so I just wanted to talk a little bit about the liquidity parameters discussion that's been happening. There's a part one and the part two. While the Foundation engineering team has been focused on the Solidity implementation of the RAM, the R&D and community teams have been working with the community to discuss and signal support for the different parameters within the RAM. On the next slide, I'll kind of go over and talk a little bit about the different phases that we've gone through so far. So we started in July with the RAM education guide and asked members for any questions out of that first liquidity parameter discussion. During that education phase, Ray and I held office hours, answered questions on Discord and the forum to ensure that everybody had a solid understanding of how the RAM works and how the parameters would impact the RAM. And then in mid-August, we started part one of the liquidity parameter discussion, where we asked members 3 core questions. The first question being, what is the amount of NXM or ETH that should be able to be redeemed and exit in the short term at a price close to book value? Question 2 is, over what time frame should this NXM be redeemed, that being the initial exit period? And then question 3, in the long term, how long should it take to get down to the minimum capital requirement based on the current cover amount, assuming everyone exits at maximum speed? So during the part one discussion, we talked about those questions. Members shared their opinions on what the potential answers should be. Those were collected and put into a variety of snapshot signaling votes. After that part one discussion wrapped up, the 3 snapshot signaling votes were held to gauge member support for the proposed answers to these questions. I'll review the outcome of that shortly here on the next slide. First, I wanted to talk a little bit about the part 2 discussion, which is going to start this week. So with the initial forum post going up sometime later today, the part 2 discussions will begin. During part 2, our goal will be to determine how the parameters needed to achieve the outcomes that members signal support for in the part 1 discussion. In part 2, we'll go through and outline those parameters, but you can actually find those in the overview post, which you can find in the community calls resource guide that I posted earlier today as well. So very similar to the part 1 structure, we'll have a discussion for a week, and then we'll have those snapshot signaling votes. In this case, it's just going to be one signaling vote where people will choose the parameter package that they think best represents the parameters we need to achieve the outcomes that were signaled in part 1. Ray is also going to put some analysis and simulations on the forum to give members greater insight on what these potential parameters will look like and how they'll impact the RAM. So again, we'll review those parameters, analyze R&D simulation and modeling of different potential parameters, how they impact the RAM, and then share our respective thoughts on the parameters that can help members achieve the voting results from part 1. So looking forward to kicking off part 2. Of course, we're still going to have the third part, which is talking about the Oracle buffer and some of those other parameters, but those I think will be a little bit more technical in nature. Part 1 and part 2 so far in this discussion have been the ones that members have been most focused on and most eager to participate in. But on the next slide, I wanted to talk a little bit about the signaling vote outcomes. So these votes were held last week. They closed on Saturday. First off, I just wanted to say thank you to everybody who voted. We had more than 1.3 million NXM that voted during this period, which represents about 20% of the total NXM supply and 31% of the NXM supply that isn't held in the wrapped NXM contract. So we had a pretty high turnout for these signaling votes. For question 1, members signaled the majority of their support for option 3, with 46.34% voting in favor of option 3, which is 30% of the capital pool, or 28,000 NXM. For question 2, the majority of support was signaled for 1 month, and the result there was about 80%. Question 3, members signaled the majority of their support for 3 years, with around 77% voting in favor of that outcome. And now that members have signaled their support, these values will inform the part 2 discussions. These will kind of be the North Stars that we're looking at when we're looking at those parameter packages. Again, you can find the particular parameters in the post that goes in the forum later today, and also the recap that we posted in the overview before we started the part 1 discussions as well. I just wanted to stop here for a moment. I know I've covered quite a bit. Does anybody have any questions about anything I've covered before I move on? Okay. If not, I will move on and talk a little bit about the economic audit that Chaos Labs is going to be performing for us to make sure that the economic design of the RAM is sound. So when we launch, everything is done safely. With this partnership, I think it's important to note that there was an RFP process that Chaos Labs, among others, went through to find the team that would best fit our needs for this economic audit. But this kind of fits into a little bit of the broader security strategy. From the start of the tokenomics revamp process, all of the teams involved have emphasized that security is the #1 priority for this project. The Foundation engineering team will conduct a lot of testing on the RAM smart contracts once they're completed, and smart contract audits will be scheduled as the implementation process nears completion. And in addition to that, we've selected Chaos Labs to conduct an economic audit of the RAM mechanism design. Over a 10-week period, Chaos Labs will undertake an in-depth review and stress test the Mutual's RAM mechanism design to evaluate its resilience under typical and adverse market conditions. And they'll also provide a sense check and suggest changes to the RAM parameters being set by the community. If they identify any, they'll develop strategies to protect the mechanism against any potential manipulation. So during this 10-week period, they'll go through, they'll do their audit, they'll give recommendations on if any of the parameters should be updated ahead of any on-chain vote. And then if there are any changes that need to be made, the engineering team will have time to do that as well before the smart contract audits are executed as well. And last week, the Foundation met with the Chaos Labs team to go over the finer details of the mechanism design, and Chaos Labs work is underway. So like I said, this will continue on for 10 weeks. They started last week, and I'm really looking forward to working with Chaos Labs. For those of you who aren't familiar, Chaos Labs is very active across DeFi. They are service providers within the Aave DAO. They contribute to Compound governance. They're very active. They've worked with the Uniswap Foundation and quite a few other major DeFi protocols to provide economic analysis and risk parameter updates. So it's a great team to work with, and I'm very much looking forward to their report after the 10-week process. So with this economic audit, the solidity audit, extensive testing, I think the foundation is well on their way to ensuring that the RAMS launch is done as securely and safely as possible. So if there are any updates on the economic audit, we will share those on the forum and the thread for the KS Labs announcement as well. But I will move on and we can talk a little bit about the staking dashboard. Sam will go over and share the screen so we can kind of go through this. So last week, the R&D team published the Staking Dune dashboard, and with this dashboard, members can explore staking statistics and analyze where managers are allocating stake NXM, what the historical NXM rewards have been, and individual staking pool stats. Looking at the dashboard here, you can see the total amount that's been staked in V2 to date, the average staking APY across staking pools, and then the max staking APY within the staking pools, and that's based on a 30-day average. If we scroll down a little bit, we can see the total amount of NXM staked here across different products. You can see the NXM that's been allocated and the staking leverage being used by the pool managers. There's a nice breakdown here of the NXM that's staked in pools and then the NXM that's allocated by the various pools. You can scroll down a little bit and see the individual pool stats. So this will show you staking stats by pool. You can see the pool ID and then the corresponding stats there. And then you can see in this bar graph here where the staking rewards are coming from. So you can see that we've seen a lot of rewards coming from Aave V2 cover buys. But there you can see the distribution of staking rewards, what products they're coming from, and where the demand is and where the rewards are flowing from. There's a lot of information here. You can see who the biggest stakers are, the total amount that's been staked, the staking burns over time to pay claims, and then the amount that's staked against certain product types and individual product listings. So with this should give you a lot of granular detail about staking to see where people are staking. You can look for a little bit more detail across some of the other dashboards and some of the other stats. But this has been the fourth dashboard that the R&D team has launched. You can check out all of those dashboards. We've linked those in the resource guide in the chat today as well. But this is very much a dashboard that I've been looking forward to have a high-level view of what people are staking against and to just get an idea of where the distribution of staked NXM is, and to get a sense if you're looking to stake your NXM or open up a pool, what the rewards look like and what risks have been most profitable so far. So yeah, great big thank you to the R&D team for all their work on this. And then we can jump to the next slide, and I'll talk a little bit about the different investment allocations that have been made. So as we approach the end of the summer and the kiln allocation has been completed, I wanted to review the capital pool investments that members have approved and highlight how these investments are expected to contribute to capital pool growth. The investment committee has outlined the recommended risk buckets, which detail how much capital should be allocated to certain investment types. As it's been shared before, ETH staking represents a lower risk investment based on the investment committee's recommendation. And this provides yield that is hard to beat from a risk versus reward perspective. And you can see those risk buckets there, that graphic, and you can also find that on the forum as well. Allocating capital pool ETH also requires diversification across different ETH staking protocols or platforms, because we want to be able to limit risk and also promote client diversity within the ETH staking ecosystem. I'll talk briefly about the Mutual's investment history and the current investment allocation. So it was in May 2021 that the initial investment in Lido ST-ETH was approved by members. Roughly 15,000 ETH was staked in Lido, which at the time was the only liquid staking token that had sizable liquidity and a reliable oracle, both of which are prerequisites for a capital pool investment. Then in September, the investment allocation to Lido was increased by about 14,700 ETH, which put the Lido STETH investment at that 20% maximum investment threshold, based on the limits that the investment committee had recommended. And then in April 2023, we had a variety of investment proposals that were put up on the forum, and members voted to allocate 14,400 ETH to stake in Rocket Pool for our ETH, and then to allocate 6,624 ETH from the Nexus Mutual Enzyme Vault within Kiln. So in total, Nexus Mutual's capital pool holds just about 54,000 staked ETH, which is roughly 37% of our capital pool holdings. On the Lido investment, since the initial investment was made, the mutual has already added over 3,000 STETH to the capital pool since that first position was staked in 2021. So we've seen a sizable amount of ETH flow in from that investment. But using the average APRs that are available on each ETH staking provider's website, I've put together a projection for investment earnings over the next year, just to give folks a rough idea on how this contributes to capital pool growth. So in total, the capital pool should accrue another 2,287 staked ETH worth of value from current investments. That's about 3.75 million at today's ETH price. For members who only hold NXM and do not stake, the yield per NXM is about 1.6%. That's the projected APY for each NXM based on the current capital pool size and our current investments. Talking about the results from the part 1 liquidity discussion, if we saw 30% of the capital pool leave through NXM redemptions, then this projected APY for each NXM would be about 2.24%. Going back to what we talked about with staking, if that is just the native yield you're getting by holding NXM because there's growth happening in the capital pool that doesn't even account for the cover fees that are coming in from cover buys, then if you participate in staking or if you contribute in other ways to the mutual, you could earn more NXM rewards and improve that yield over time as well. So there's a lot of opportunity there, but I think we're seeing solid cover buys come through with these investment allocations so far. We're helping grow the capital pool, and these capital pool investments are pretty foundational to contribute to capital pool growth over time. And as more investment proposals are posted on the forum, members will have a chance to review, discuss, and vote on these future capital pool investments. So look out for future posts and reports by the investment committee on the forum. And for a breakdown of this, you can see the section in the docs, which I've linked in the resources, as well as the capital pool and ownership dashboard on Dune that you can see through the Nexus Mutual account. And I will jump to the next slide and talk a little bit about Nexus Mutual and news. So again, now that we're at the end of the summer, I wanted to highlight the news coverage that the mutual has received over the last several months. The Foundation Business Development Team has been hard at work to grow cover sales and expand into new crypto-native and real-world markets. So in June, Blockworks covered the Chorus 1 purchase of E/slash cover from the mutual, and this was the first node provider to buy cover for their users, so a pretty big deal. We saw a lot of coverage from other crypto-native media outlets. So in June, we had that coverage on Chorus 1 from Blockworks. In July, the block covered the mutual's partnership with Figment. The mutual offers cover to Figment users who are staking their ETH through Figment. And the block also covered the mutual's diversification into our ETH, since that was the largest swap that was made on CowSwap to date. So we've seen a lot of positive coverage there. The Geneva Association also published a report about the future of insurance and blockchain technology. Hugh contributed some quotes, and Nexus Mutual was featured as one of the key use cases. So this is kind of getting away from crypto-native media and getting more into people evaluating the intersection of blockchain and insurance. And then we had, in August, pretty extensive coverage of our partnership with InShare. So that received quite a lot of news coverage. We saw it in CoinDesk, Reinsurance News, InsurTech Insights, among other outlets that share the news on LinkedIn and various social media. So that's more of the traditional insurance press that's covering this, in addition to crypto native. So our name is definitely getting out there, and there's a lot of awareness building around the mutual. We've seen growth in visits across our social media platforms and kind of an uptick in curiosity about the mutual. So I think there's a lot of work that's been done by the foundation teams, the DAO teams, and members themselves. I think that's something that we should celebrate, and I just wanted to note that before summer wraps up here, because this is definitely something to note, because this kind of lays the foundation for future cover buys. And yeah, I definitely think it's something that everyone should be aware of all of the word about Nexus Mutual circulating around in both crypto native press and traditional press. But on that note, I'm going to hand things over to Hugh so he can share the foundation update. Hugh?
Cool. Thanks, Brave and Sam. Yeah, several things going on with the foundation. Probably I'll back off some of the comments that have already been made, but I think there are three main engineering kind of priorities right now. One's obviously tokenomics, so we're in kind of full-blown testing phases at the moment. We've been spending a lot of effort kind of onboarding Chaos Labs, getting them up to speed with the details, and explaining to them how it kind of works and the objectives and that type of thing, because it's a bit different to like lending protocols and other protocols out in DeFi. So there's a decent amount of kind of onboarding effort on that side. So that's all going well, and they've even started kind of pulling together some initial thoughts and that type of stuff. I think in general, what I'm hoping to get out of the Chaos Labs, like the ideal outcome here, is that they go through, they don't find any major issues. They give us some reasonable ranges with which you can set the key parameters in, and those ranges are wide enough that that essentially the voting and the snapshot votes that we've had have fall within those ranges. So that's kind of the ideal outcome, and hopefully one I'm expecting to happen, but you never can tell. And so that's the ideal route, and then therefore we can just effectively implement the packages that the snapshot votes have been indicating. So that's the ideal scenario. Obviously we have to wait and see, but we're progressing on that basis. So that's kind of the one main priority from an engineering point of view is tokenomics. The second one is we're working through cover edits. So increases, focusing on the increases first, because decreases is actually quite technically tricky. So that means extending time period and amount on covers. And so that's kind of the other smart contract work that's going on. We're also testing phase of that. The other big piece on the engineering side is UI, so UX type review, and so we've engaged an external UX team to kind of go through workshops and user interviews and kind of come up with some suggested changes and things. And so they've pretty much done that now, and they've got like basically samples like wireframes and stuff all there for us to play with, and we're going to be looking to implement that gradually. Probably might take us 6 months to get everything out there or something like that. I'm unsure at this stage, but it's not going to be around the corner next week. But there's some really cool stuff in there, mainly focused on the buy cover side and the staking side. So the staking side definitely needs a bit of love, but the buy cover side also, I think there's some key things we can make better there. And in particular, like, what does someone do when they come and they don't see that there's any capacity? Because often you can message the stakers and we can get the stakers to stake. So how do we kind of close that loop and stuff? So there's some good work going on that side of things. So those are the kind of three main focuses for the engineering side. On the sales side and product side, we've been spending a lot of effort developing some new products, especially, and talking to people like on the D&O side. We've also developing a crime product, like a cybercrime product. So these are kind of more traditional insurance products ported to Nexus Mutual discretionary cover, and so we're hoping those are going to open up a few more channels here, because there's a lot of brokers that sell traditional insurance policies that can't get enough capacity and coverage, and we've been discussing a lot with them, and hopefully we should have some early signs, but we're looking to hopefully have some success with some brokers and getting them kind of compliance sign off to be able to recommend Nexus coverage. So there's a lot of work in the background on those types of relationships and stuff, which I think are quite powerful long term, because they allow, open up different distribution opportunities. So you can get brokers and stuff actually involved in the mutual as well. So that's kind of an interesting development. There are also some other, I'd describe them as kind of real world type options that we're exploring that they're looking quite positive, but they're still relatively early stages. And so there's I think there's a lot of stuff going on over there, and I think the main high level aim there is that the traditional insurance markets are massively starved of capacity, and we have capacity to deploy. And so how can we bridge essentially crypto capital to real world risk? And so, there's kind of technical side of things, and there's legal side of things, and there's regulation side of things as well. So, trying to cover all those aspects off and working out where the opportunities are. So there's been a lot of work on that, and that's continuing, and will keep going for quite a while. But there's a potentially quite large opportunities if we can make that happen in various places. And I guess TRM was a good example of the first step there. So that's probably the main stuff. Obviously happy to take questions on any of that.
Okay. If there are no questions, we can move through the weekly analysis. All right. So looking at the last week in cover sales, we saw two fairly large cover buys. One was for Balancer V2 and one was for HATS protocol. Balancer V2, there was a little bit more than $2 million in cover sold. This cover was purchased after the disclosure that Balancer had announced about the potential vulnerability. Balancer has since gone through and mitigated that. They've been really great on their comms about that. And then the HATS protocol cover buy was our first native protocol cover buy, where the HATS team purchased cover for their users. So between those two cover buys, we saw about 2.15 million in cover sold and 2,700 in fees earned. So down a bit from last week, where we saw a little over 9 million in cover sold and a little over 30,000 in cover fees earned. We will talk a little bit more on the next call about the cover by cover type. There is an issue with that pie chart on Dune, and the R&D team is aware of it. They're checking it out and they'll look into it. So we will post an update on the forum about that once that Dune dashboard is back in working order. But I will open things up for any members who have questions, or anybody who wants to raise anything that wasn't covered on the call on the open forum. Okay, if nobody has anything, I just have one thing that I wanted to highlight before we wrap things up. If you look in the Nexus Mutual user interface, you'll notice that we have updated the MakerDAO cover listing. So MakerDAO before was a little confusing. We had questions about the DAI savings rate, about Spark lending, and about the MakerDAO protocol itself. So to simplify that, we've broken things down a bit, and the MakerDAO coverage we have will cover your assets if you deposit into a vault, if you open up a collateralized debt position, and borrow DAI. We have coverage for the MakerDAO DAI savings rate, or SDAI, and that is available for a lower cost. So hopefully, if pool managers see that, evaluate the risk, and stake against it, I think ideally we'd see a lower cost of coverage, but of course that's up to staking pool providers. So people who are depositing in the DSR who want to buy coverage can buy protocol cover for their deposits in the DAI savings rate contract. And then coverage for Spark lending. So if you're using Spark and you're using their lending markets, which is just a fork of AVP3, you can buy coverage for that as well. I'll have a post up on the forum talking about those different products, what they cover, and how members can take advantage of that up on the forum in the next couple of days. And I see Butter does have a question. So Butter is asking Hugh, how can we make money on real-world insurance using our capital without taking any risk? Surely there has to be some risk.
Yep, there's risk, just like there's risk writing smart contract risk or whatever. I think perhaps you're asking what like the bridging risk and stuff like that is. I guess, there's the TRM probably example is probably the best one. So with the retail mutual, basically the retail shop owners pool the risk together themselves, and then when or if their claims get above certain limits in a particular period, like a year, or there's a one-off large claim, then that's when Nexus Mutual's coverage kicks in. So it kind of acts similar to a reinsurance layer would act in the insurance industry. And so that obviously we're taking on risk there because, we could, our stakers could get burned and we could pay money out of capital pool because we're paying our members cut for cover. So that, that's obviously kind of part of a product. I guess what you're saying is like, what's the additional risk there? And I guess the additional layer of risk there is potentially the fact that for the claims, we're essentially kind of relying on the retail mutual and the directors to not be fraudulent, because if there's a claim, they kind of have to provide evidence that they've paid out these claims, etc. And so versus like a smart contract risk where you can just look on chain and you can see exactly that type of fraudulent risk is relatively low. It's still kind of there in other ways, but I think that's kind of probably a bit of incremental risk versus what we do at the moment. I think that's perfectly fine, but something to be aware of. And I guess with other kind of real world type things, it depends exactly on the product and how and what the counterparty is, etc. But generally, you're going to have to rely more on it's really the kind of claims assessment aspect that's going to be a bit different. Like, how do you do the claims and what data source are you relying on to perform the claims assessment? So that's probably the bigger area to be aware of.
I guess Butter is typing as well. I think the two follow-ups, if you hadn't seen them, he's asking, is it worth the risk, and what kind of industries are you guys looking at?
Yeah, just saw them now. Well, I think, is it worth the risk? I think yes, definitely. Obviously, different ones are going to be different, and you have to assess each one on its individual basis. But that's kind of up to the syndicates, the staking pools, to kind of assess that. They're the ones putting the stake behind, etc. So they're the ones that got to come up with the right pricing. You have to pick and choose and be sensible about it. And then we're essentially relying on the incentive alignment there between the staking. And what industries? I think the first one, I think it's cross industry. I think it's not necessarily a particular industry vertical. It's more where it's going to be easier to bridge. And I see a few areas where it's easier to bridge. One are discretionary mutuals themselves. So TRM is a discretionary mutual itself, so it doesn't require its kind of reinsurance or excess risks solution to be regulated insurance. So they're quite happy with the discretionary mutual model, and so therefore it's easy to kind of offload risk to Nexus. So that's kind of one segment, and that can be discretionary mutuals operating in all different industries. And then there are probably other segments such as crypto businesses that are buying more traditional insurance products. And so I kind of, that's kind of, maybe you call it real world, maybe you don't call it real world. I don't know where the line is exactly, but it's crypto adjacent. It's not like pure crypto specific risk, which we have been writing with like smart contract, etc., or slashing. But it's like liability type coverages for crypto businesses. So it's closer to real world risk, but the crypto users are more comfortable using us than like a regular user that doesn't it's not involved with crypto. So so it's easier for them to onboard. So I think which industries we're after, it's going to be initially ones that have easier to onboard, for whatever reason. What kind of ROI? So it entirely depends. It's such a wide variety, and it, like, for example, the pricing on TRM is about 5.5%, and so. But you can do that. You can reallocate that stake, so it depends how much you've geared the stake. So it's really quite the ROI question is very difficult to answer. I think one thing in the mutual in particular is that at the moment the ROIs are relatively low for staking, etc., but they have a lot of capacity to go up because you can reuse stake across a lot of. You can get some leverage because that's the whole model of insurance. So what we have to do here is primarily about increasing demand and you do that by increasing distribution, and this is one way of doing it. So once you get distribution happening, then you can leverage up your capital base quite a lot, and the ROIs can go quite high. So it's asking that question is a bit on one particular deal. It gets a bit of an awkward situation because it depends on if you're using that capital just for that deal or if you can reapply it. So so it's a bit of a difficult one to answer. It's insurance. You're always taking some risk somewhere, and it's all about selecting the right ones. I think the TRM deal in particular, things can obviously go wrong, but we analysed like 19 years of claims history on it, so we got a decent look at the underlying details there before we decided on the pricing. That's one aspect to it. But I think this is more about. Less about specific risks and the risk you take on that. It's more about opening up channels. So once you open up a channel and get approval from brokers to provide to use you as coverage, you can make a decision whether you want to decline something or price it high or whatever. But I think, and that's kind of one decision, but to actually get in the game and get the option of actually providing coverage, that's kind of the first step. And that's really what we're focused on right now, rather than particular deals.
I think the other thing that's worth noting, we've seen a lot of other DeFi protocols that have allocated capital to real-world investments, but that includes them actually bridging that capital off-chain, and that money is custodied by some particular legal entity or it's held in T-bills, and there's some off-chain counterpart. Whereas in this instance, what we're seeing is this capital remains in the capital pool and we're underwriting coverage, and we're offsetting risk for another discretionary mutual in the case of TRM in the real world. So we're not bridging any capital off-chain. We're just offsetting risk much in the same way that we do for on-chain risks with the same infrastructure. It's just a new type of risk that we're able to cover now that V2 is live. I guess, Butter, for your question, could you be a little bit more specific? An example of what kind of situation? Are you asking about claim triggers for the retail mutual coverage? Okay, yeah, I'll let Hugh speak to that, to the claim triggers in the TRM cover wording.
Yeah, I can't remember off the top of my head, but you can have a look at the detail of the product the cover wording. I think it's if an individual claim is above £200,000, and if the accumulated claims over a year mean that the underlying loss ratio for the TRM is above 57%. So they're expecting about 2 million sterling of cover costs or cover fees per year, and so if the claims exceed 57% of that, then we would start kicking in, and there are limits where it drops off. So maximum we could pay out on that is, I think, about 2.5 million, something like that. So it's all in the cover wording, and it's all public, and you can look at that on chain if you want the specific details. It covers things like fire or robbery or accidental damage or flood or something like that.
Okay, so I think we've got time for one more question, Butter, if you have one more follow-up question, and then we'll wrap things up. Okay. Well, thanks for asking your questions, Butter. Happy that we could provide some explanation. All right, well, I think if there's no more questions, we will wrap things up today. Thanks everybody for joining us on the call. Like I said, we hold these calls every other Tuesday at 9 a.m. Eastern. And as Sem said, I believe our next call is on September 12th. The recording for this call will be up sometime tomorrow. And we will share any updates in the governance roundup that will be posted on the forum this week. And our next newsletter will be published in a little over a week's time. Thank you again for joining us today, and we will see you on the next call. Bye, everybody. Have a great week.